Our next panel is Regulations That Move Markets, Financing Hard-to-Abate Sectors. I would like to call onto the stage Lylah Davies, who is a policy analyst at OECD, Clean Energy Finance and Investment Mobilization. Lylah, all the best. You will introduce your panelists, and over to you. Can we give her a nice warm hand of applause? Thank you.
Thank you very much. So, I'm not sure if you can hear me, but I'd like to invite Dr. Marjane, first of all, President of the Institute of Finance and Sustainability and Chairman of the Green Finance Committee. He has spent over 3 decades shaping sustainable finance, domestically and internationally, including as a former co-chair of the G20 Sustainable Finance Group. Thank you very much. There you go. Thank you. Rodrigo Lauria, Director of Climate Change and Carbon at Vale, the Brazilian mining group, where for over 23 years he has worked across operations and finance and now leads decarbonisation efforts. And Bertrand, Head of Sustainability at La Caisse, one of Canada's largest pension funds, where he is one of the architects of its climate strategy. He is a seasoned investor in infrastructure and corporate debt in emerging markets. So thank you very much for joining us for this session. In this session, we'll be discussing a subject that the room probably knows very well, how regulation and standards really are reshaping where capital is going, and the challenges and opportunity in steering this towards the hardest sectors to decarbonize. And so here we're talking about hard-to-abate sectors, which include steel, cement, chemicals, aviation, heavy industry, and which account for around 30% of global greenhouse gas emissions. And under a business-as-usual scenario, this could rise by 50% by 2050. So this is a really key sector that we need to be thinking about. But this is also a business opportunity. The IEA estimates that transition finance could reach roughly 4 to 5 trillion over the next decade. And these needs are really expected to be concentrated in emerging markets and developing economies, which account for about half of the cumulative investment over the next decade. So policymakers have built a considerable architecture, taxonomies, disclosure standards, transition plan requirements, intended to give the market clarity and direction. But investors and corporates also need to think about costs, demand signals, and also fragmentation, of course. So maybe I should introduce myself as well. I'm Lylah Davies from the OECD, where I work on private finance and investment in clean energy. And our work really tries to look at the demand intermediation and supply side of finance. So looking at the policy and regulatory frameworks that shape investment, looking at blended finance and risk sharing, and also looking at the financial markets themselves. And so I'm really excited for this discussion today and the range of distinguished panelists that we have to discuss the topic. And really for this panel, the idea is to focus on 2 things. What the panel is seeing in terms of challenges and opportunities for financing decarbonisation of hard-to-abate sectors today, and then also where the opportunities and risks lie moving forward. So I'm going to turn first to Rodrigo. So you've spent over 2 decades at Vale, and you've put in place, in fact, the internal carbon pricing, which is at the centre of how Vale is allocating capital. But steel decarbonisation ultimately depends on whether Vale's customers in Europe and in Asia are willing and able to pay the premium for lower carbon inputs. So a big question is, how do you make the investment case right now for decarbonisation in the face of potential uncertainty?
Thank you for the question. Thanks for having me here. Good morning, everyone. It's a very interesting question, because the best way to address it and how to start the discussion is starting the discussion. You know, as you mentioned, we know that the challenge is a huge challenge, because you don't have all the assumptions or levers ready to be implemented. But at the same time, it seems like if we wait, we can lose and make a market opportunity. So how do we see all this decarbonization efforts at Vale as a business opportunity? So what we decided to do in 2020 was to start. We started probably not implementing the best tool that we had at the time, but we started. So At the time, we took a common price for the whole business, so it was a standard pricing. And the idea was to evaluate the NPV of the projects using a carbon pricing once you don't have a carbon pricing in place. 5 to 6 years later, we moved this discussion to a more business-oriented tool, I would say that, if I can say in this way. So we have different prices for different geographies, different prices for each kind of product that you produce. And the idea is to use a very concrete tool to analyze the NPVs, saying if I don't have a carbon price, how can I count on this initiative, and try to compare the NPVs. So by doing this, we trying to put in the NPV evaluation all the levers that we can to approve the project. So we have, for instance, the carbon taxations in the countries. We have C-bands, for instance. We have all kind of new energies that can be applied. In the end of the day, the idea is to show to the board of directors, say that it's possible to use this as a concrete tool to foster this agenda. So essentially, it's what we did and started, again, 5 years ago, and now we're implementing and developing this tool.
Thank you. A really important point about not waiting and getting started there. So let's turn to Bertrand and look at this from the investor perspective. And so institutional investors are under increasing pressure to deliver financial returns while supporting the transition of emissions-intensive sectors. So first of all, would you agree with Rodrigo? And also from your perspective, how do you assess whether a regulatory framework is genuinely helping to reduce investment risk and opportunity, and unlock opportunities, rather than simply increasing reporting requirements?
Thank you for having me. I would fully agree. You said sustainability is a business opportunity or something like that. Exactly. And your question about regulation is interesting because we're actually not regulated. But the point is we are imposing on ourselves standards voluntarily because it is good business practice. We have a commitment to invest 400 billion Canadian dollars by 2030 into either climate solutions and companies that decarbonize. We've defined that. We use largely European taxonomies to do so. We're not European, we're based in Canada. But it helps having a framework to guide you as to where you're going and then implement it. That's very, very important. We also recently, in talking there from the industrial side, we co-hosted with the CSSB, the Canadian Sustainability Standards Board in Montreal, and this is the alter ego of the ISSB, to 15 companies. And we had 3 CEOs from those companies explain to us how those regulations, those standards, help them have discussions with their management teams to come up with responses to the climate challenge. What are they going to do? Physical risk, business opportunities that may arise, business risks that may arise, and come up with an answer, and how this was helpful. So it needs to be looked at not so much as a burden, but rather as a tool that helps progress in the thinking that needs to be to take place within management teams and within boards to progress on this agenda.
Okay, thank you. So that's really speaking to frameworks being in place, but also thinking about opportunity and ambition as such to take them forward. So this is a really great view of the state of play, of what's happening right now. And so I thought now we could turn to Dr. Ma, who's in fact helped design China's green finance architecture and has played a major role in developing green finance frameworks and scaling sustainable investment internationally. So are you seeing the same challenges and opportunities from your perspective? And what lessons can other jurisdictions learn from China's experience about using financial regulation to mobilize capital at scale?
Thank you very much. I think we tend not to use the word regulation. We put standards to facilitate market transaction rather than limit, activities. And in the very beginning of this journey towards setting up a green finance framework, that was like 12 years ago when I was a chief economist in the Chinese Central Bank. We began to think about ecosystem that needs help, from the regulators, incentive providers, and marketplace, and so on. So we put in place a 35 policy actions coming from 7 ministries, and it's forming what we call the green finance guideline, or the top-down sort of framework for green finance. And after 10 years of operation, it worked. China now is the largest green lending market, largest green bond market. The outstanding green loans and bonds is 48 trillion RMB, equivalent to more than $7 trillion US. That's an outstanding amount, which really helped the massive growth of the green economy, the solar, wind, battery, electric vehicle. The China production of all of these is about 70% of the global total. And each of these is financed by green loans, green bonds, and green something else. Now, within the ecosystem, there are a couple of elements which are coming from regulators. One is a taxonomy. From day one, we had a taxonomy because we want to make sure we don't want to see hundreds of taxonomy, everybody claiming, we are doing the green stuff and end up with greenwashing. So we had a green taxonomy, and we, on a mandatory basis, we ask all the banks to use it. You have to report the amount of green loans to the regulator on a regular basis, and we do auditing, making sure you're not cheating. So that's the taxonomy thing. And on the incentive side, we actually use the taxonomy-based data to provide incentive. What do? We ask all the banks to report the green loans and the green loan ratio. In Europe, they call green assets ratio, which means that the outstanding green loans as a percent of total loans, right? And this green loan ratio in China, banking system average is 17%, but some of the better banks are doing 34%, some of the lower ratios like 5-6%. Once you have a ranking of the green loan ratio, it becomes an incentive, because the ones with a very low ratio is looking very bad. And the chairman of the bank will basically ask the green finance department, hey, what are you doing? Yeah, do you still need your job? Why you are ranking number last? Yeah. So without monetary inputs, it creates incentive. This is kind of architecture which we actually put in place a long time ago. 7-8 years ago, we had this ranking instrument. And the other one is real incentive. For example, the central bank in China, we put in the Decarbonisation facility, which allows the banks to finance a renewable project now at only 1.25% interest rate. So it's essentially a central bank subsidy for renewable energy projects. But of course, it has to go through a commercial bank to extend the loan. It's like on lending from the central banks through the commercial bank to the green projects. And it's probably only 100 basis point subsidy, but has a massive leveraging impact, which means that without that, you probably see a slowdown of the renewable growth by half. And with that, you're really crowding a lot more private sector money than otherwise. So I'm not calling this regulation. It's coming from the regulator, but in fact, it's incentivizing, encouraging, boosting, rather than limitation. Yeah. So this is a little bit of experience on the past on the green finance part. The last 3-4 years, we began to work on transition finance. It has the same structure, but very different contents. For example, we needed taxonomy for transition finance, separate from the green finance. And now the central bank put out the transition taxonomy for 11 sectors, a few hundred pathways, clearly written in terms of description, in terms of the 5-year sort of carbon reduction achievement and so on. So it will simplify the recognition of transition activities by the users, whether it's bank or it's a corporate sector. Also, in some locations, we encourage local governments putting subsidies for transition finance. Like in one of the pilot cities, they give 50 basis points subsidy on any transition loans, which is doing great. In this particular city of Huzhou, they were able to generate 70 billion RMB worth of transition loans last 2 and 3 years. It's about $10 billion US in a small city of 3 million people. So we're seeing massive potential growth, as I guess you said, multiple trillions needed, right, for transition finance. This is feasible, yeah, just judging from this particular example of a small city and doing $10 billion US in a couple of years' time. And if you follow that, it will be a few trillions for the world.
Thank you for these comments on facilitating market transformation, Will, and particularly emphasis on taxonomies, incentives, so not just financial, but also in this sort of peer pressure as such and visibility. Some really interesting points there. So let's go back to the investor perspective. So Bertrand, we've just heard about what's worked to mobilize capital at scale. So from where you sit, actually deploying capital, what do you think would need to change for industrial decarbonisation to become investable at the scale that's actually required today?
Thank you. I'll just give you a few reference points. A car in this country, any sort of basic models, there's less than a ton of steel in there. A ton of steel costs £1,000. The car costs £20,000. So if the ton of steel is green, it'll cost 50% more. We're talking £500 in a car that costs £20,000. We're talking 2.5%. And if you phase that over 5 years, you're talking an increase in the cost of the car of 0.5% per year. Not even less, 0.5%. Now, you look at a building, a 20-story concrete building here. Okay, that data comes from AI, so, bear with me. But it's probably right, because we all know the cost of building a building in London is labor. It all needs to be done by hand in a high-cost country. The steel, there's 1,000 tons of steel in the building, so £1 million worth of steel. And the building cost anywhere between 50 and 80 million pounds. And it's labor and the finishings are super expensive. So a 50% increase in the cost of steel will add at most 1% to the cost of the building. What are we waiting for a regulatory point of view? There's a stick, which is called carbon price, but carbon price has been passed to consumers, but it hasn't been sufficient to move industry yet. It's not high enough. There are protections, CBAM, etc., that are being put in place, which is the right thing to do. But we need a demand signal. If you look at what's happening in aviation, the European Union has imposed the blending of sustainable aviation fuel in fuel, small percentage, with a planned increase going forward so that the cost is shared across the industry. What are we waiting for to ask for car companies or building companies to say, next year, 20% green steel, the following year, 50% or whatever, and just continue like this? And if there is demand, somebody will produce it. It's a market economy. And you're not warping the market with subsidies and whatever. You're just introducing a signal. And by the way, this is not rocket science. It is what was done with renewable energy and what is still being done. Renewable energy 20 years ago was way above the grid price, and government said, I want those electrons, and we'll pay over the odds. And that created a huge decline in costs over the years. And now renewable energy is cheaper than the non-renewable sort. So that's the thing that we need. And of course, we need predictability in the regulatory system also. That's key.
Okay, thank you for that. So I think one of your points at the beginning was quite interesting about the green premium really not being an insurmountable challenge. But also that there is still a need for, on the regulation side, some support on the demand signals. So really, really interesting there, and also, of course, on predictability and continuity. So let's move back to Rodrigo. First of all, feel free to comment on what Bertrand's just said, but also let's go back to steel specifically. The OECD's framework on net zero transition points to the enabling conditions that have to sit around finance, so stable policy, infrastructure, and demand. So from where you sit in the value chain, and in fact from the producer side, what policy, regulatory, or market signals would give the confidence to actually accelerate investments?
Yeah, first of all, I need to reinforce what Bertrand just said, because, you want to solve a complex problem trying to use single or simple levers. And I do believe that we have been discussing a lot regarding regulation, carbon pricing, and you just reinforced this. Is the right thing to do. But I do believe that and totally agree that we need a more clear signal on the demand side. So public procurement, from my perspective, would be the next lever that should be studied, discussed, deployed, you name it, because if not, we are still, it's not bad, and again, it's the right thing to do, for instance, this kind of movements, such as Mission Impossible Partnership and so on, it's an amazing movement. But in the end of the day, the total amount of the product that can be mobilized is so slow, and so there's a very few really commitments on the purchase side. So from my perspective, I would say public procurement is key. It's key to really address where the potential of this demand, and as Bertrand just said, and it's important to reinforce, in the long term, you create a market movement that's no turning point, which means if you start now, probably in 5-10 years, we will be purchasing green steel or green whatever as a regular product, and not as something that should be priced with a premium to really be a feasible option. So, I mean, public procurement.
Thank you for this. So turning now to Dr. Ma, you've worked on, you've really worked on this internationally on various topics, as you mentioned, green finance, transition finance. So where is the greater alignment most urgently needed to stop fragmentation, slowing investment right now?
Now, a couple of areas of sort of a need for international cooperation. One is the taxonomy. Mm-hmm. When China publishing its taxonomy 2015, it was the first official taxonomy. Then Europe, I think, was the second largest economy that's publishing taxonomy 2020. And as of now, it's 40 taxonomies by 40 different jurisdictions. We're going to see like 200 taxonomies in the world. And now this thing, if done uncoordinated fashion, it creates actually market entry barriers. For example, you have a green bond, which is issued in one country, labeled against its domestic taxonomy. It cannot be sold in other jurisdictions if they use a different taxonomy, right? And to overcome this problem, in fact, 5-6 years ago, between China and EU, we created a taxonomy working group under the International Platform for Sustainable Finance, which began to work on common ground taxonomy. And we had the first version of that 2020. Actually, 2022, it's a joint piece of work between China and EU. It's called China-EU Common Ground Taxonomy, which is an overlapping portion of the Chinese taxonomy and European taxonomy. It had like 72 items, which are the usual suspects, like solar, wind, batteries, electric vehicles, and so on and so forth. And after this was published, many Chinese issuers began to issue international green bonds using the CGT, or Common Ground Taxonomy, as a label. It worked because the increased recognition of these items being green and increased subscription ratio and reduced funding cost. So 2 years later, Singapore joined this exercise, and we made it a multi-jurisdiction common ground taxonomy based on Chinese, European, and Singapore taxonomy. I think efforts like that will be needed going forward to actually bring more economies into this interoperability exercise of taxonomy. In fact, Brazil expressed interest, South Africa expressed interest, and we need to really work out a mechanism where more jurisdictions with the existing taxonomy come together to form something that's all agreeable, at least for international cross-border transactions. That's one effort. The second one is interoperability of disclosure standards. And back a few years ago, we have so many standards, framework, templates, and methodologies, and so on. If you need to follow all of these, it's going to be hugely costly for a company to sell your products, to raise money, or invest in other jurisdictions. And that's why ISSB came up. I was still co-chair of the G20 Sustainable Finance Working Group 2021. And the proposed ISSB came to the G20 saying, can you endorse us to become the global baseline for sustainability-related reporting? And we discussed and then we agreed. So with G20 endorsement, with ISCO endorsement, now ISSB is officially adopted in 40 jurisdictions. But still, they need to convince the other 150 countries to adopt it, which is some way to go, but it's a very good start to converge the reporting standard and simplifying or avoiding duplication of the efforts on reporting. The third area of coordination that I think is needed is voluntary carbon markets. As of today, there are 40 different voluntary carbon markets in different jurisdictions. And many of them follow different standards, reporting requirements, MRV, requirements, and so on and so forth. And as a result, many of the smaller voluntary carbon markets are not recognized by international investors because it's too costly to understand the different standards and methodologies and all that in a small market with local language. So some sort of interoperability become more important in terms of raising the liquidity and capacity of the voluntary carbon markets to really incentivize decarbonization actions. And that's why I think some effort is needed, which is likely to be led by international organization. It's not announcing yet, but in, I think, later part of this year, we might see a IO coming to create an international carbon market network, which will aim to, generate interoperability of standards across different voluntary carbon markets and facilitating Article 6 transactions.
Thank you for that. So we've covered a lot of ground, and we only have a few minutes left. But we've looked at the demand side of finance, the supply side as well. We've covered a lot of really interesting points. So what I want to do is give my panelists a few minutes to give their key takeaways to try and draw this discussion together. And what would be interesting is if you can actually address these comments to another part of the room. So Rodrigo, perhaps if you can highlight key priorities that regulators should consider. Dr. Ma, perhaps a message for institutional investors. And Bertrand speaking to corporates. Please go ahead, perhaps starting with Rodrigo.
Super. I'll try not to be repetitive, but I will. I think we should keep this discussion as pragmatic as we can. As you just mentioned, all these initiatives are there's no rocket science inside, but it is more about coordinating all the efforts across the globe. So I think this should be the mindset. We don't have much time to wait, so keep it as pragmatic as we can. And again, let's start by what we can really unlock the bottleneck. So again, public procurement is key from my perspective. Try to understand the carbon markets and what's the rules and how those markets will be connected. It's key. And for sure, to understand the really value of the incentives, because if not, we can move the needle to the wrong place. So these three, for me, are key.
Bertrand?
I would say, we have with thousands of companies in our portfolio, and some are doing nothing on climate. Some are doing things and then lobbying regulators against climate regulations and various other things, which is to us a cardinal sin. I would say to companies, lobby regulators in favor of climate action, in favor of finding solutions to advance the agenda, and work with regulators and finance together. It's a tripartite thing. I'll give you one example of this in action. 12 years ago, we invested in a US-based coal-fired power plant in Indiana, a coal state. On the 29th, and the rationale was to decarbonize the company. On the 29th of June, so Monday, we will have closed all coal units. And we work with the regulator in a coal state with the company to push, to reduce, to get renewables, etc. That's what needs to happen.
Thank you. And a final comment from Dr. Ma?
Yeah. Now, maybe focusing on transition finance, what financial institutions can do. I think a key bottleneck is that most of financial institutions, they don't understand the transition pathways. It's very technical. And but they are in the best position to advise a company what to do. So the internal building of capacity to understand technology, especially the recent technology that really can reduce carbon at the same time making money for them, is so important. Now, most of the financial institutions I talk to, they understand some technology which is 3 years old, yeah. And but technology is moving so fast. For example, energy storage cost goes down 20% every year in China. Yeah, and water treatment, water desalination cost can be now reduced by 50%. with AI operation and modular approach. So all these technologies need to be made available, need to be understood by financial institutions when they present it to the company saying, I want you to decarbonize, but here are the tools for you to decarbonize at the same time making profits.
Thank you for these comments. And so I'm unsure if we're out of time or if we have a few minutes for questions. I believe we do actually have some time for questions. So perhaps I'd like to open to the room if anyone would like to introduce himself and ask a question to our panelists. Please go ahead.
Right, I don't think I need a mic. Hi, I'm Mindy Luber from Series. There are a number of sessions everywhere this week and everywhere we go on AI and data centers. Data centers are moving forward, some are getting stopped, but mostly tens of billions of dollars. How do we assure that those data centers are being powered by renewables and not locking us into more natural gas? And part of that's a regulatory answer, but as we speak this minute, some data centers are making decisions, or hyperscalers, to use natural gas to fuel a big part of those data centers. It'll be different in every jurisdiction, region, what's going on in the grid, but how do we influence those decisions now?
Can I try? I had this discussion on this issue last few days. I give them 3 examples of how to avoid building data center which is powered by fossil fuel. And one example is in China, we have a province, Guizhou, which is a mountainous area. Their data center is built inside the mountain because within the mountain it's so cool. You don't need much of air cons and all of that. So it reduces the usage of power. And that's one example. But of course, the user of data center is somewhere else. You have to be connecting the data transmission, right? In order for the users to put the data center in a remote place where the power usage could be massively reduced. This is one example, which is possible in China because we got coordination between provinces and so on. The other example is that in the Mongolia, which has a massive, very, very cheap solar, I think they can do it within like $2 per kilowatt. And they can power the entire data center with 100% green power. But again, you have to move data, from Mongolia, a few thousand kilometers to Shanghai and Shenzhen, where the users are. Again, it requires interregional cooperation. And the third example, which is a project I've been looking at, is in Indonesia, a lot of land which is available for solar and hydrogen production, which then can allow this hydrogen to be moved by ship to Singapore to power the data center in Singapore. Because Singapore has no land and there's no way you can do huge amount of solar. So all this requires interjurisdictional collaboration, which the government need to play a role. Yeah, if you are limited to by one private sponsor of a project with no resource in other places, you will probably have to use gas or coal, which is available locally.
Thank you. Would you like to add to that? Okay. Okay.
David Harris from LSEG. Looking ahead, we've got 6 months to COP31. What should both business and finance be engaging governments on between now and COP31, and how should we be showing up at COP?
I would say more focused tripartite discussions on how to get there. Tripartite, one industry, finance, and government. So steel, cement, transport, whatever. Because those great declarations and these great concepts, okay, they are there already. They exist. But we need to get down to business. And business is not going to get done with more declarations. It's going to get done on the ground with industry. There's also, okay, you might say what I'm going to say is self-serving, but enough talking about not enough money to do this. We, in finance, we write checks. The people who are doing projects, they're here. It's industry. Finance itself is not going to make things happen. We can stop enabling damaging behavior, yes, but we can only provide money. We're not building plants. Even in renewables, we don't do that. We use industrial partners. And so there must be more tripartite focused discussions between the parties and at the industry level. Otherwise, it's too broad.
And if I may, I can complement on. We already, I'd say, converged to a common ground. For SB Corp, for instance, a huge example. More than 4 million companies across the world decided and submitted real concrete cases that can be bankable, investable, and so on. So try not to lose the momentum of the SB Corp, because SB Corp can address exactly what Bertrand just said. It's a business-oriented business-oriented initiatives, sector by sector, and trying to leverage this kind of financial mechanisms and regulatory mechanisms to speed up things. So it's a combination.
Would you like to add anything? So we have a few more questions. Please go ahead.
Thank you. I'm Natalia Rodriguez. I'm from the University of Cambridge. And I think it was very interesting what you were saying about the interoperability. And my question is more on how to unlock the trust that is needed to build that sort of collaboration between partners and like bringing different regulations or standards together into just one. How do you unlock that, especially in a climate where governments are shifting, geopolitical context is very hard? How to build those conversations that allow that interoperability?
I think this word of coalition willing is very much applied here. Give a couple of examples. Back 2016, when China was presidency, we began to socialize among the G20 economy on the possibility of setting up a G20 green finance study group, which was successful because we actually need to talk to the G20 members before setting up that. And early on, half of the members were sort of suspicious of what you want to do and unsure about the consequences. And some were concerned about, if you're doing too much of green finance, you will not be able to finance the rest of the economy, right? Green finance at that time only a few percent of GDP. And would you stop the 95%? So that kind of a concern. So we were able to manage to convince them, at least we will do the good things on the margin, right? But tentatively not touching the existing one, but we mobilize new money for new green sustainable projects. So they got agreed. And but the G20 didn't. It was shocked by many geopolitical factors. So for example, the U.S. left the Paris Agreement in 2017, and then we decided to do a NGFS, the central bank network of greening the financial system, which involved only initially 8 central banks, because the U.S. was not involved. And this was another success of a smaller coalition. But eventually we went up to like 100 central banks joining, and it's now becoming the real sort of standard set on climate risk analysis, supervision, and disclosure, and so on and so forth. So there are ways to structure a coalition, initially with smaller number of willing parties, and then over time demonstrating that this is beneficial to all the participants and maybe benefiting the potential participants, and then they will come and join.
But I would add to that and say that that train has left the station. We're getting there. You look at all the international taxonomies, the Chinese taxonomy, it's similar to the European one, it's similar to the Brazilian one, ISSB is helping. So the standards are converging. International finance is converging. In Canada, we don't have a taxonomy. We're working on it today. But the players already use European taxonomies or whatever. So I'm encouraged by that. There is a movement really to converge, and that's good.
Brilliant. So I think we've run out of time. Clearly, we could keep speaking about this for hours, but I think 2 of the last key messages were around ambition and alignment. So I think those are really positive messages to kind of leave the panel on. So thank you very much. I've had a fantastic panel. So it's been a pleasure having this rich discussion, and thank you to everyone for engaging in this discussion.
Thank you.